Well, thank you and welcome to the session, Pedaling Forward, Market Forecasts. Obviously, we're going to try to look ahead. This is right ahead of the cold drinks and the nice wine at the Grand Ballroom reception, but we really have a fantastic panel here with really complementary viewpoints and expertise to help us look at the market in the long term with big questions like, what's the price? How will we make money? And how is that going to impact the innovations? Our speakers come from wide and near. Jan Frommeyer is coming all the way from Germany with ICIS. He's the Director of Market Analytics, and they are providing a pricing and market analytic services to look again at the carbon market and the environmental markets. And Greg is actually with CE2 Carbon Capital, and the president there, and they are an active market investor and one of the leading carbon market investors. So he's going to be coming from the perspective of a market participant. And Noel, as the founder of Next 10, they are very active in the intersection of policy and innovation. And they're obviously the whole idea of the carbon markets is to drive that innovation. So it'll be interesting to see how pricing, investment, whether or not that all adds up to the impact. So I'm going to start just by looking at the bigger picture with Jan. I think by the time, if you have been to any of the other panels, we've been talking about California and the sort of prices in California. We want to maybe start by staying a little closer to California and the fact that prices have been nearing the floor, and although the auctions have sold out. So I want to ask Jan to kind of bring out his crystal ball. So where's prices going to be in 2020, and how are we getting there? What are the shape, and what are the sort of big drivers for that?
Yeah, thank you, and thank you for having me here on the panel. We at ICIS, we believe that the market is oversupplied, but we challenge a bit the resulting idea of that this necessarily means that prices will trade at the floor price all the time. Because we believe just looking at emissions alone does not give you a proper view of the demand. So we believe, as you correctly said, the market is oversupplied, but all auctions sold out. So apparently there is significant demand in the market for CCAs, and we try to model the supply and demand in this market over time. And if we do this, which we did for years in the European system and works well in an oversupplied market, we come to the conclusion that there is hope for California. So we believe that there will be periods in which the market will see so-called artificial shortages. So it means there will be periods in which we will see more demand than supply in the market, which can significantly lift the price of the floor. And with this combination of fundamentals and behavior, we can estimate at which point in time these market prices will deviate from the overall fundamental price. So we believe that even though we will trade in the years to come pretty close to the floor price, there will be periods, for example, in Q4 this year, where we believe prices can well go north of $13. And we believe that it is just dangerous to believe in the common consensus and rely on this consensus that markets will trade at the floor price forever. Consensus is probably correct, but it's dangerous and makes it a bit lazy if you just rely on that prices will stay there forever. So we believe there's hope for the market. We think prices can lift significantly off the floor price in the years to come.
Before we move on, give me an example of one of these things that could create a imbalance that you talked about, a temporary or short-term imbalance.
Yeah, fair enough. So we believe that at the moment the fuel supplies that enter the market in 2015 are a bit in legal limbo. We have the Steinberg bill at the moment, but so therefore we believe that they are a bit cautious on this market. They will come in 2015, and with their entry in the market in 2015, the cap will increase significantly. Therefore, the auction volume will rise significantly in 2015. In fact, we'll have record high auction volumes in 2015. However, we believe that these companies will buy part of their allowances up front. So we believe that these companies will engage in this market more actively in the second half of this year. And in particular, the fourth auction this year might be a very, very interesting one, because we will see additional demand coming in the market prior to this heavy supply that will come once the companies really start to be covered.
So Greg, you have to put real dollars into this. And does this market scenario fit what you're... Does this market scenario fit what you're seeing?
Well, I think it's easy to say that the market's oversupplied, and I like the way that Jan thinks about the market, because the market's not a linear process. It's a series of supply and demand bursts, if you want to think about it that way. We don't have a crystal ball. The way we prefer to think about it is we have a dashboard, and we have many decisions to make along the way. And, in my remarks, I just wanted to kind of focus on some of the things that we think about, because I think the way to think about this market is it's evolutionary. And in some ways, that evolution can be disruptive or not, and you'll see what I mean by that in a moment. But there are a whole bunch of factors in this market that I think you have to watch in real time, simultaneously. You have to see how they change. You have to feel your way around the way the political winds blow in this market. It's not just the participants that make this market. These markets are unique because these markets are created by governmental entities. And in our case in California, the ARB. So, what this panel might be called is Decision Making Under Uncertainty 101. And, the regulatory aspects of the market are subject to change. So, for example, what's the role of offsets going to be in this market? Are there going to be new offset protocols? Are people going to invest in offsets? Is RED going to come into the program at any point? That's, the potential for RED is quite substantial. It's a big swing. There are folks who believe that it might, and then there's a point of view that say it's just too complex, both politically and legally and for other reasons. Buyer liability, what will that do to the impact of offsets? Right now, buyer liability, in our view, has been a drag on offsets and has really held down the offset market, whereas as opposed to the offset being a tradable commodity, the offset is a CCO8 or a CCO3. Well, at some point, in our view at least, the offsets, it would be great if that wasn't the case and there wasn't buyer liability. But on the other side of this, what will be the impact of offsets when more offsets are issued and when CCO3s become CCO0s in effect, and something is really a CCO with no contingent liability associated with it? Jan mentioned the Steinberg bill. Is there going to be a carbon tax? Is there not going to be a carbon tax? It may look like right now the oil companies will come in as expected, but if there should be a carbon tax, that will have a tremendous impact on the market and will create a very large swing. Low prices. Look at the REGI market. REGI suffered low prices for a very long period of time, and then the regulators said, okay, well, we can do something about this. We can send a more robust price signal. We'll evolve the framework under which the market operates. So there's no reason to expect that wouldn't happen in California. Time is an element in all of this. So, I can't say when it will happen. It's certainly not tomorrow, but it's an evolutionary framework where you can have disruptive regulatory events that really change the outlook. Post-2020 caps, right? So right now, there's a 2050, theoretically a 2050 cap in mind. There are folks talking about a 2030 cap. What if the market has sent a signal with specific post-2020 caps? Specific meaning in 2021 the cap will be this, in 2022 the cap will be that, so you can actually plan. That feeds back into how people will make decisions around the market, not just in their allowance portfolio and their obligations, but also how are folks going to invest in emissions reduction projects and offset projects. What kind of methane reductions are going to be put into the market? So for example, there aren't going to be enough offsets in this compliance period. I would contend that there won't be enough offsets, at least as projected, well into the second or third compliance periods. So how will you deal with high global warming potential gases in that scenario? There's 9 million landfill gas credits sitting in the car registry and in other registries that could come into the program at any time. Is that going to be a swing factor? So, is the program going to expand to Canada, to Washington, to Oregon? Are those going to come in? Will the existing source standards that come out force a greater integration as different states seek to get grandfathered into the regulations? So this is not a, it's a linear market. It's easy to see it's short based on kind of what we know today, but the uncertainty around what might happen tomorrow is really, when you stop and think about it, you can see, it's really extensive. The amount of free allocations, think about that. How much free allocation are the oil companies going to get, natural gas utilities, as they come into the program? And then, what is federal policy going to be between now and 2020? A lot of this, it's not going to turn on a dime, but it's going to turn, and it's going to have an impact on the market. So those are all regulatory framework-driven aspects, and I'll kind of wrap up. But the allocation of the attention of the market participants to market-related factors, the availability of offsets, the acceptance of offsets. I'd contend that there won't be major blow-ups in the offset markets, major invalidations, and there will be CCO zeros at some point, and that market will become much more commoditized than it feels today. You'll see, we've seen it in the last few auctions in California. You've seen different market participants taking a view on their preference for forward vintages versus current vintages. That's a capital allocation issue and a view of the risk and the longevity of the market. And then finally, will there be economic growth in California? That can have a big swing. Will water policy play a role? And then, you think about the construct of the California market and how the reserve price accelerates over time. So it's 5% plus an inflator. Well, we're all used to this very low inflationary environment. You look at the Federal Reserve policy, you look at the printing of money, there's no reason to believe that we're in a permanently low inflation environment. So it's not unreasonable to expect that you could get some meaningful price swings vis-a-vis the inflator over time. Yeah. So,
but just to follow up with it, when I hear that, I hear risk, uncertainties.
Welcome
so
to carbon.
That's right. Yeah. So for an investor, does that imply you have to apply a high discount rate right now, or a high threshold?
I think so. As an investor, you have to look at this as a very risky investment. Right. And if you take the time dimension to that, not knowing when these events will happen, if at all, you have to apply a very high discount rate to it.
And now I'm going to flip that to the buyer side. That means there's a terrible, for the seller side, the project developer, how do you argue against that without this sort of high discount rate and high return expectations from the investor, it's a good time to develop projects?
I think that even in a low price environment, there will always be a role for offsets, because offsets should always trade at a discount to the allowance price. So you have a natural inflation working its way through the allowance price. And then with respect to the offset price, as long as you have certainty that the market will exist, you should be able to run your model and say, does my offset project make sense? Right? Under a low or, under some price scenario.
So Noel, now turning it over to you, with these scenarios of low prices, occasional spikes, and the original concept that there's going to be this price on carbon that's going to drive clean energy innovation. Now you've already observed that maybe that investment is not being made to the degree that people anticipate. Now when you consider the long-term price discussion that we just had, what does that say to you about the prospect of innovation driven by the carbon sort of market, if you will?
Thank you, Peter, and thank you for inviting me to the panel. So I'm optimistic about clean technology investing. Absolutely, I did tell you, and it is correct that clean technology investing over the last few years has been down. Maybe we're in a trough, and hopefully we're going to come out of that trough. Over the last 10 years in California, there's been billions and billions of dollars that's been invested in venture capital funds that have funded various entrepreneurial projects, large and small. There's also been a lot of project finance, which many of you know about out in the desert, these big solar projects. And kind of like the rest of Silicon Valley, if you look at chips and if you look at the intranet and biotech, you know, there's this kind of wave action. And maybe one could argue that the clean technology investment area is moving towards greater maturity, which I think is good. And also in the last few years, well, let's go back 8 to 10 years, there was a lot of venture funds that had little or no experience with clean technology investing, perhaps didn't really understand how long or longer it takes to create an investment and run it out to its end, as opposed to just inventing something in a garage, and also maybe didn't understand how much capital it was going to take on some of the capital-intensive projects. So anyway, a lot of these people get involved, and a lot of those people are not in the market today. However, there is a core foundational group of investors that are continuing on. Steve Wesley of the Wesley Group and Nancy Fund of Double Line Investors have continued to do well. And so maybe this is really an opportunity for new investors to come into the market where the pricing might be good. But Peter, I want to go back to your original question about what does this mean? You know, what does the carbon price mean to clean technology investing? And I would, I appreciate the comments of my colleagues, and I would say, I think from what I've been asked to comment on, which is clean technology investing and the impact of the carbon price, I would say that the carbon price, we have a fairly low, the carbon price is at the low end of the range right now, and it's my opinion that that is not going to stop the continuation of clean tech investing here in California for 3 reasons. Number 1, the cap. Number 2, AB 32, and number 3, the mandates. I think in the short term and possibly in the long term, the cap, screwing it down, is going to, you know, companies have to figure out, they have to solve problems. And part of the solution is in technology. You know, AB 32 is a suite of different products or different policies. And then the mandates, you got low carbon fuels, you've got clean cars, RPS, energy efficiency. So those are going to continue to drive clean technology investing. And also, I think it's important to mention the revenue that's going to come from the auctions. Some of that money, it's not clear to me, I think they're trying to figure it out right now. Some of that money is going to go into technology, it's going to go into transportation, some of it's going to go into infrastructure and energy efficiency. And that's really important too, and I think that the state should be looking through the lens of those funds as to how those funds can be used in the future to help solve the problem as the next few years evolve and it gets harder for the larger emitters to solve their problems, and we need some of that new technology. So, and I'll just end finally by saying, well, what happens if it doesn't seem to be your perspectives that there's going to be a high price, but I guess it's pretty intuitive that if the price does go higher, that would be more inspirational and incentivizing for clean technology investing. However, maybe not so good. A very high price is not very good for the consumer or maybe for the program.
So on the programs that you talked about, the RPS is almost done. But the investor-owned utilities have already over-procured. So what else? What's really more promising for you from a sort of commercial success standpoint of the ones that are still, the mandates that are still to be done?
Right. Well, I think low carbon fuels is really, really important. I know that's a controversial area, but I think that there's great potential in that area. And also, I think an exciting area to watch is the battery area and the PUC saying, you know, there's a mandate in terms of battery storage that the PUC recently came out with. And that's very exciting because there's already a lot of battery storage companies here in the Bay Area, but I think that could be really inspirational to kind of jet start that area. And then RPS, hopefully that's going to be raised. We don't know, but...
Well, on that topic, I mean, we've seen maybe in other markets renewable energy over generation. Now, Jan, if that happens, you know, what's kind of sort of impact in California to the carbon prices and market and supply and demand?
I would say there's an obvious impact, and that would mean that we have lower emissions. So lower emissions means the system is further oversupplied, means the overall demand of the sector reduces further. Actually also reduces the demand for offsets, because the offset limit is linked to the emissions. But I think there's also an implicit target, because if you look at the scheme of things, and if we look a bit beyond 2020, and I mean there's huge uncertainty. So if California manages to green its economy very quick, and I mean by now it seems that there's no additional emission reduction needed until 2020. So this might increase the odds of taking on a more ambitious 2030 target, or in general. So the economic downturn the world has gone through makes it affordable to take on a more ambitious target post-2020. So even though I would say, of course, there is a somehow negative effect for prices in the short term if there is more renewable energy production, it makes it affordable to take on a higher target 2030 and beyond, which we need. I mean, the 2020 target is just the first step and was decided based on the rationale, how much can we afford at the moment. But in the current situation in which we are, and the quick gains we had over the last years in California, but also in other places around the world, make it affordable to take on a much more ambitious target for 2030. In fact, the European Union is at the moment currently discussing to reduce from 2020 to 2030 their emission by 20%, which was their target from 1990 to 2020. So the first 20% reduction in 30 years, the next 20% reduction in 10 years. And that's in the end the way we have to go if we really want to achieve this overarching goal of stopping climate change.
So Greg, then sounds like in that view the big upside for prices is it's going to have to happen in Sacramento. Right? I mean, there's different parts of Sacramento. So sure. to move the cap up, that's probably a legislature. But are there things that you've observed recently with what Reggie's doing in terms of program rules and so on that could also have what you call pricing upside?
Well, there are a host of things that they could do. There could be a more ambitious cap. There could be fewer allocations, free allocations made to the participating entities in the program. But I agree. A lot of it will come from Sacramento. Economic growth is another exogenous variable. I think that we'll just have to wait and see in the end.
Right. I want to just point out that there is a mic here, right, near the front of the room. So if you have a question, please stand behind it, and I will call you. And while you're thinking about your questions, I'm happy to just ask one more clarifying questions. So we talked about economic growth. In the base kind of forecast that you have, what is the long-term growth rate that you're picturing for California? And what is a upside? Is it going above by a whole percent, or is it just a matter of tenths or
you're talking about the GDP growth?
Yeah, that's right. Yeah.
Well, we assume average growth forecast as ARB is using, based on the fact that I would not say that me myself, sitting on the other side of the world, could forecast this growth better. And in the end, we don't know. So again, I would say there's an explicit and implicit effect in this. Of course, if the economy grows stronger with more emissions, but on the same time, there might be a reduced willingness to take on a stronger target later on. So there are always multiple sides to the coin. And while I totally agree over the longer term, these are important factors to play a role. But I would say over the next 2 to 3 years, this system is in a very important phase. And we see that California went very quick from the first phase of the hooray, we have a market, everything is great, $18 We are short. Very strong forecast out there to this consolidation phase in which we're in at the moment. So low prices are more, the easy wins are gone. So, and I fully agree with Greg, at some point we just need a fix. The system is working to some extent, but there are certainly parts that must be fixed. And we see other systems in the world that are oversupplied on the East Coast, RGGI, in Europe, the UETS. They all went through the very same three phases. So it is just obvious that at some point in time there must be a tweak to the system. And I think, like Greg said, I think more important than renewable energy production, nuclear scenarios, GDP growth is the Sacramento. Political will, and maybe beyond Sacramento, so EPA, additional laws for new coal-fired power plants, states joining the system, or maybe even the international climate negotiations in Paris in 2015, where it seems that the US and China are completely taking a different approach, quite proactive on a high global carbon price, while Europe is more on the brakes.
Before they speak, Peter, could I say one thing? Following on Jens in Sacramento, so, what I'm going to say is not original, but I think it bears saying, and that is that when we think about the short and long-term health of the carbon market in California, it seems to me that, and others, that the most important thing is this target, that we have a target beyond 2020. And I know that the Area Resources Board is working on that, and it seems like it's really the legislature and the governor that need to affirm that, to really make that what it is. But it seems like, as I said, for the health of the market, that is absolutely important. And coming into the area that I was talking about, clean tech investing, that will be very good for that. It will be very good for the price. It will be very good for clean tech investing.
And if prices stay low, there will be a market reaction that creates less supply of reductions of one form or another. Right? It's less compelling to take action, behavioral changes as a facility if you have a low carbon price, at least to the extent that you wish to monetize your reductions or need to. So
we have a question. If you could just briefly state your name and company or / organization.
Yeah, hi, my name is Phil Martin. I just moved over from London 4 weeks ago, so I'm representing myself as an individual.
Okay, good. We all do. Yeah,
yeah exactly. I did work in the energy sector in Europe for the last 4 years, and we worked with a number of exchanges focused on the emissions side. Now, just following on from what you said, and especially what Jan said there in relation to the kind of the purpose of a market, it seems to me the goal is to reduce emissions in a market. Currently in the EU, we have seen very little evidence that this actually happens. We've seen a price drop to a level that meant it incentivized energy production from coal, far more polluting than gas, and actually disincentivized gas, leaving gas unprofitable. We also had a situation where the EU allowances were being used as a repo tool by utilities, loaning out to banks and funding on interest rate, which was great for the investors, had nothing to do with emissions reduction. So my question really comes from, what do you guys see as the sort of the key drivers to meet the goal of reducing emissions rather than just the goal of serving somebody making money in the market? Ideally, I'm sure in Greg's position, you want to do both. But it seems to me that it's not a dynamic speculative model if the market is going to reduce emissions. It's something more where it's incentivizing clean technology and clean production of energy. How do you see it progressing to a point where both sides of that equation are balanced, or can it ever actually achieve that? Because in the EU, it doesn't seem to have done so yet. I mean, you can make some money and you can reduce emissions at the same time.
Thanks. Jan, you want to start?
Yeah, so first,
Go.
First I would like to challenge a bit the view that the EU emissions trading scheme has not reduced emissions. I think that's not entirely true. And even though the prices are low, it's still quite hurtful for some power plants, in particular lignite and coal-fired power plants, to produce. Nevertheless, you're right, coal-fired power plants and are running much more than gas. It is a bit hurtful, but so I would disagree that there were no emission reductions at all based on the emissions trading scheme, because that's a very interesting point, and that's where we come to the broader scheme of things. I think when emission trading scheme starts, it's the first time that companies really have to realize that it costs to pollute, that it costs to emit a ton of CO2. So, and therefore there's for the first time this idea and this rationale of incorporating a carbon price into your investment decision. So I worked at a utility in the very beginning of my career. So at that point in time, we had to do 50-year-ahead carbon price forecasts, which is ridiculous. But in the scheme of things, if you have a gradually decreasing cap, all these super long-term forecasts a ridiculously high carbon price. So even though if this scenario never materializes, at the point of the investment decision, this was incorporated. So there were investment decisions taken under the scenario where you expect high carbon prices. And I think this is probably, from my view, the answer to this. If you can provide certainty, or if you can provide incentives to invest in low carbon technology right now, as soon as possible, and this can only be done with some certainty for investors like you that there will be a high carbon price in the years to come. And there's the crux of this market. It's a politically driven market. And if we know one thing, certainty does not come from politicians. So that's the problem in which this market is operating. However, if there's an overarching goal and will of achieving a long-term target, then I think there is some certainty for investors to take still risky decisions, but invest in more emission reduction measures right now. Because we should not forget, the earlier an emission reduction measure is invested in, and the earlier it is applied, the more emission reductions are happening until 2050. So we don't need a high carbon price in 2040. We need it right now to incentivize these emission reductions right now.
Yeah, I always think, at the base level in a cap and trade program, that the cap is the cap. And the idea is that you know you're going to get what you get under the cap, and you're not going to get that, for example, under a carbon tax. And then when you think about AB 32 more broadly, the cap and trade program is really just one part of it. So it's heavily enforcement driven in some of the other parts of it. I think that should give people a lot of comfort that there are going to be real reductions here.
I want to maybe this one point that he made, which I want to maybe to see if you can comment since you're closer to the ground, is that investors are making money in the European scenario. I mean, my anecdote is that maybe some folks in the early days have, but given the current long-run situation, that nobody's making money. I don't know if that's true or not.
It's really hard for me to comment on what's going on in Europe. But if I looked, at a bellwether, I would say that there are a lot fewer people working in the cap and trade industry in Europe today than there were several years ago. So I wouldn't suspect that people are making a lot of money doing this.
Could I just throw in on that? That's so true. There used to be a carbon desk in every, well, you'll be very familiar with this, Jan, in every single entity that was transacting in energy markets. There is now the occasional carbon trader, and he's likely to be doing coal or power or something as well. It's completely changed the dynamics. There are no longer the speculative desks that were going to make the fortune for the companies anymore, that's for sure.
We have next question.
Yes, David Wright. I'm with Plains All American, but I'm asking this question more as an individual. I'm coming from the industry standpoint, and particularly the petroleum industry. One of the major frustrations I've had with all the cap and trade programs and all the other incentive programs out there is they're just not efficient. I mean, if you truly want to reduce carbon, you should be able to take projects that can be certified anywhere in the world and do those projects and try to do the most economical projects that are going to reduce the most carbon. Do any of you in your professional view ever see this system getting rationalized to the point where it'll start really truly working on that basis?
I think that's more, that sounds like an offset question.
Well, I guess in the end it is, but, I think, this is a market that's being designed from the top down, and it's a market covering a specific geography. And the vision right now, at least, of what types of offset projects might apply in the market is you know, in its very early days. So you know, there's no reason to believe right now that you know, if you think about it, the CDM to some extent did what you just asked for. And there's no reason to believe right now that you're going to see that kind of wild expansion in the types of projects that are allowed into this market anytime soon. In fact, you know, coming at it from a different angle, which is the bottom up here as opposed to a top-down design, you know, folks like us are just fighting for more and different types of offset categories, especially offsets from methane, to have them be allowed to come into the program. And there's a lot of low-hanging fruit in the methane you know, production sector, if you will, whether it be pneumatics or landfill gas or coal mine or mine methane. And you know, that's we can't even think that far ahead. It's really a battle for, you know, what's next, and trying to you know, foresee the capacity to do this work within, you know, the regulatory bodies.
Yeah, so I appreciate that question, and I have a question back to you. So do you think that, so would you scrap cap and trade and just work discreetly with various projects around the world that one knows one could reduce the emissions from? Or what would be your approach? And how would that affect your industry? Yeah.
Well, in my view, you know, one of the things that's important is the ability to prove that the emission reduction really occurred. That's a fundamental that has to happen. But it's basically, you have to take the program worldwide. The CO2 problem's worldwide. And as a society and as a human race, it's going to go from 7.2 billion to 10 billion in the next 30 years. We've got to figure out how to reduce carbon everywhere very quickly. And unless you come up with a global program that can be rationally optimized, you're just not going to get there. And unfortunately, the demand for energy is going to go on up with this population growth. So it's got to be accelerated, and it's got to be done on a rational way. But it needs to let the true laws of economics work. So if you have a refinery in LA and you're supposed to reduce a certain amount of pollution, if you had to spend $20 million to do that, wouldn't you be much, much better off going to China and cleaning up a very dirty coal operation over there or some other operation, as opposed to spending a whole bunch of money to get a very, very minute change in the LA basin? I mean, the logic just breaks down totally when you look at it on a global, long-term basis. So I don't know the answer, but that's the problem.
Well, so great. You talked about expanding categories. There's also a point here being made, expanding geography, especially here for California acceptance, if you will.
Right. You know, I think, you know, the vision, you know, we've been doing this since really 2004, and the vision of many people at this conference is that this would have become a truly globalized market by now, and it's clear that that's not going to happen anytime soon. So, you know, I think we're in the early innings, and this is the walk before you run part of the program. And we're going to have to show success in RGGI, success in California, and hope that that becomes a broader a functioning broader WCI. And that's the way you get to it. And that's the history of some of the other, you know, successful environmental markets in the United States. There was a bottom-up evolution, and then they became regional, and then they became nationally run programs. And, you know, you can boil that up to the global. I don't disagree with your point, but we're just so far from that right now that we kind of have to take, you know, what we've got and make it work.
So Noel, you have one more comment, and we'll go to the next question.
So I absolutely understand what you're saying in terms of how it doesn't seem to be happening around the world. But the way I'm kind of approaching it here in California is that California needs to continue to do a really good job running our climate program, our cap and trade program, continue to be an example. And we noticed, or some of you probably have noticed, how China is China seems to be cutting back on its growth rate because of the pollution. They're not growing as fast. And then India, you know, we have severe issues, and we just had a problem in Paris. So I'm of the belief that we need to be patient. We need to here in California, we need to continue our successful program because I think I see the world eventually coming to us for policy and technology solutions. It's not imminent, but you know, we saw a couple of articles this last week about you know, the climate change challenge by the scientists. So even though it doesn't seem like it's imminent, I believe we need to hold fast, be patient, do well what we're doing, because there will be change, I hope, but I'm speculating.
Next question from the audience.
Hi, my name is John Melby. I'm with the Melby Group. I want to take the conversation a little bit from the global view, which I actually absolutely agree with you and agree with the comments of the panel on, but bring it down to our program here and address the Steinberg bill. And I know that it was touched on in the opening comments, but my question is, what are the impacts of that bill on the market today, and also if it was implemented, what might it do to prices in the marketplace? Thank you.
You know, it's hard to really say the impact of it today because you have to get under the hood of what the big oil companies are doing. You know, if I had to conjecture, I'd say maybe it's forestalled a little bit of demand in the very near term, but eventually that would swing back if they're a part of the program. If there was a carbon tax and the oil companies were exempted from the program, you know, for the cap and trade program, it would not be a good thing. And I would argue that you're not going to get, it's an easy out in many respects, and you're not going to get the true adherence to the cap if you have a carbon tax. And it may seem an easier fix for some because it's difficult to implement cap and trade programs. It's not easy work, and I think the ARB has done a good job in doing this. But it wouldn't be a good long-term venture, and you know, the result would be you know, it would take a lot of demand out of the marketplace, and you can you know, guess what that does to prices.
In the end, I fully agree. So it would be on the political side quite a hit to the market, but just trying to put this a bit more controversial, I would say maybe it's even good for the market. So of course, not everything is good on that, but what would happen is the result would be in the end that the allocation so the free allocation to all installations would be reduced significantly as of 2015. And that's counterintuitive, right? Because you would mean, okay, just the sector drops out and the cap is adjusted accordingly. But what it means is because the advanced auctions that happened over the last years were linked to this big cap of 350 million, all of a sudden, once we move to 2015, there would be not enough allowances to actually allocate all these free allowances that were promised to the industry. So that would mean that all the smaller players in this market that so far can just lay back, relax, and enjoy the smooth ride would all of a sudden face a shortage, or at least a large majority of them, because their allocation would be trimmed. So even though the fundamental picture does not change so much, again, all these companies would be pushed in the market to become active and to care about emissions. So there might even be, even though I generally agree it's an overarching, would be a political hit on the market, it can bring more companies to actively engage in that market. So
Shrinks the market, but it's good for prices.
yeah, it gets people to engage with the market, right? So there is a second layer on that bill, and to be frank, I don't believe that it will ever make it to passage. But nevertheless, it is. I think there is quite a fancy little facet of that bill that is a bit overseen and could be a good part.
Yeah, and I was going to say I was really surprised when Senator Steinberg introduced the carbon tax proposal, because it seemed to me really late in the game as the carbon market has evolved in California. It's been strong, it's been steady, it's had lots of challenges, it's beat them off. And now the senator, who is an absolute friend of the environment and has been a huge proponent of many important legislative goals through the years. So I was surprised that he came up with that, and I think I'd agree with Greg that it really is not helpful at this point in time as we're about to bring fuels under the cap next year, And it doesn't seem, though, like it really has much momentum, which I think is the best for the goal of reducing emissions here in California.
And through this conversation, we touched upon the point of things that can be done additionally, policy-wise or sequentially, to keep us pedaling forward. I wanted to maybe have you put on your creativity cap now and say, now if you're given the mythical magic wand, you can change one thing in the cap and trade program to make it in your own way work better. I mean, what would that be? Noel, do you want to begin since?
Yeah, I'm not sure, Peter, if this exactly fits the question, but what I'd like to see happen is something I mentioned earlier, and that is that we get a certain target for beyond 2020. To me, if we get that target, and I would say that target to be crystallized, inaugurated, created, embellished, to become a law in the state of California through the legislature and the governor, I think that would be fantastic.
You have a magic wand. You can put a specific number to that target.
Yeah, well, we had a bunch of people together a number of months ago to talk about that, and I forgot the number. No. Well, you can just do, we're supposed to be 80% less by 2050. So this is very simple, but I just do simple math and try to figure out what that is. What 2030 is, how close. Just take that proportion and do it times the whatever that number is. And so I guess I'm not going to give you a number. I'm sorry, Peter. Thank you.
Your magic wand.
I believe there's a structural problem in emission trading markets, and California has fixed it to some extent, which is the inflexible supply. So, I mean, the auction curve in California looks like that if there's no supply at all in the auction below the floor price, then there's this very big volume coming until there's a ceiling price reached, and then there's additional volume coming. And that's a strange curve. And I think this curve in the auctions is the main reason why we have these strange price fluctuations, or no price fluctuation at all. So I wonder, what's the rationale behind this curve? In Europe, it's even worse. We have just supply, period. Almost no reaction on prices at all. So if I would indeed have the magic wand, and then instead of just changing my football team, I would say, why don't we introduce more price flexibility in the auction, also in the lower part of prices, so that we get more a funnel of which the auction can actually, the supply in the market can react on the overall economic situation. I mean, in every other market, there is a price reaction from the supply side, but it's not in carbon markets. And this carbon market is so volatile. We're planning here a long-term trajectory until wherever, but we're saying right now we can fix the supply for the years to come. No, we can't. So why don't we put some flexibility in the supply curve to smooth the price trajectory and also reduce the auction volume if prices are not just at the floor price, but even above the floor price, and just gradually release volume back into the market so that we get a smoother price curve for the years to come.
So the point here is there's a possibility that with that wave that you would take away the floor price, along with all the other good stuff.
Yeah, it would say that in periods in which we have, due to an economic downturn, due to easy wins, due to heavy renewable energy production, we would take out some volume, and in periods which we cannot foresee at the moment when it happens, whereas great GDP growth, where there is whatever else happening, a nuclear blowout, we could reinsert these volumes at higher prices, fair enough, but still we would not alternate between heavily short system and prices north of $50 and floor price all the time, but having a smoother price trajectory and a reaction on the things to come, because nobody knows what's happening until 2020, and in particular not beyond. So why do we think we can fix the supply until 2030 right now? Let's make it flexible.
Right. So Greg, going third, you can wave once to undo what he just did, and then wish for another. So.
I think I like the way Jan thinks. It's counterintuitive, and I think his observations are novel, given the way a lot of folks think about these markets. No, not at all. The emission doesn't imply anything. I'm always the guy. I was thinking the magic wand. I like the genie, and you get 3 wishes, and I always thought I would just wish for more wishes, because there are a few things that I think I'd like to see. So I'm going to take advantage of that, and a real much tighter cap post 2020 with real specifics laid out, fewer free allocations, and then the expansion in the use of offsets, not just in their usage, but also with respect to buyer liability, which I think is a major inhibitor of investment in the offset sector.
Good. Any other questions from the audience? Well, I think we're coming up on the 1-minute mark, so I want to take a little bit of that to thank our panel here and encourage you, if you haven't looked at their bios, to go to the program. Their firms and they themselves do great work, and just join me in thanking them for this wonderful discussion. Thank you.